Thanks, Rich. I tell you what, I appreciate the opportunity to be here. I want to thank Rich and Dan for always giving me that chance to join everyone today. It's always a pleasure. And I'll just jump into it. Yeah, I'm the Director of Commodities with Kansas Farm Bureau. But this is my first slide, always the same slide. To be effective, marketing plans must include pricing increments, price targets, and date targets. And then, I'm going to be sharing a lot of slides today. Hopefully, I don't take too much of Dan's time. But I want to be talking a little bit about pre-harvest and post-harvest corn marketing plans, pre-harvest and post-harvest soybean plans, and pre-harvest and post-harvest wheat marketing plans. So going to be running through quite a few things. And when I talk about these marketing plans, I do want to note that they are not advice. Really, they're meant more as benchmarks for you to consider and for you to compare ultimately your decisions and actions to, and just kind of give you a benchmark to kind of track. So with that, let's get after it. Right now we are in the midst of harvest. I believe last Friday or last week, as of September 15th, we had 26% of the Kansas corn crop harvested, about 5% of the grain sorghum. Today we'll get another update, and we'll see how much farther and how much progress we've made. But when we start thinking about post-harvest marketing decisions, the first question obviously is on-farm versus off-farm. And, on-farm clearly gives you more opportunities to shop basis, right? If we've got multiple elevators, ethanol plants, soybean crush plants, cattle feeders, various choices. When you've got that on the farm, it gives you the opportunity to kind of shop and figure out where that best basis is. A lot of times, and for many producers, they don't always have that many choices. And so really the only game in town may be your elevator. And so, that's where we go. But K-State has a great publication, MF 2474. It does help you kind of go through all those various costs on-farm storage and whether it would pay or not pay for you. When I run through my examples, I'm always going to use sort of this one-time 5-cent in-out charge. Basically, that's to cover utilities and repairs. We'll throw in a shrink. So those are two, and then I'll also have interest, okay? One thing I do want to just touch on for a second is this whole concept of variable income. I've had some producers talk to me about the fact that, that really almost makes them money by putting it on the farm because it just costs so much, and it would take an extra driver. Say that elevator's pretty far away, right? And so I've got to take, multiple trucks, and it really slows down harvest, and I am way more efficient, and I'm getting stuff done in a much more timely fashion when I've got that on-farm storage. We're also seeing a lot of producers that are so scattered out that, sometimes we're cutting pretty far away from a home base too. So it all varies, but that's something else to kind of think about, that we got costs of on-farm storage, but is there actually maybe some potential for income? On the off-farm side, really, again, it's variable cost. You have a handling charge and then interest. Typically what I'll use is somewhere between 6 and 7 cents. Corn, grain sorghum, wheat, we'll use about 6. We did an informal survey last year, and soybeans typically are a little bit higher, and so it might range a little higher for that. When we think about post-harvest marketing, whether it be corn or soybeans, grain, sorghum, on average, we actually do see seasonal increases in prices. And this is the chart for Kansas corn. This is the seasonal index. It's a 15-year 2009 to 2023 seasonal index, and it kind of shows a fairly significant rise. And again, typically by about that third week of October, we're about 75% harvested. And now see, but there's two things that kind of drive that. One, is it because prices go higher, right? Maybe you think about 2 years ago when Russia invaded Ukraine, man, markets went up, futures were up, cash was up, everything was up. So is this futures going up and just pulling everything up? Excuse me, or is it strengthening in basis, meaning that maybe my futures are kind of level and not really changing much, but cash prices are rising. And so, this seasonal increase in prices can come from one of those two places. And we'll kind of look at that here in the next few slides. Now, does storage pay? This slide is a 15-year Kansas corn price versus storage cost chart. Again, it's 2009 to 2023. And basically what I've got plotted here, and I'll explain it, and I'll follow up with one for soybeans, all the same assumptions. But basically the blue squares, the blue line squares are the actual average 15-year prices. So that 454 there in November, that's the 15-year average price for November in Kansas, based off of NASS data. Then what I've got is two scenarios. I've got on-farm storage costs, which I'm using that 5-cent in and out plus 1% shrink. Let's see here. And then I've got one at low interest and one at high interest. Let me show what those details are. On commercial storage, I'm using 6 cents a month. And again, low interest, 3.5% versus 7%. Because, some people have a lot of debt. Maybe you've got a lot of operating notes and you're more in that 7%. But maybe if you don't have any operating notes, you still might be in that 3.5% because that'd be a good return on equity. So I'm trying to give you a little bit of a lay of the land on that. But again, what this chart shows is that year in, year out, on farm storage for sure, on corn, kind of will work. Now, is this year average? I'm not saying that. But I am saying year in, year out, on average, there is a return to storage. And, you really see the same kind of thing in soybeans, maybe even better, right? We see a fairly strong rally in prices, well above those estimates of storage costs. And again, I kind of bumped up that commercial storage cost to 6.5 cents, still outweighing that clear into July. So, history would say something to consider. As we start making these post-harvest marketing decisions, though, let's think about what these choices are, right? A, I can store it, and I can put a storage hedge on, which means I'm storing the crop and I'm selling futures. Now, that's a good thing if I'm trying to collect on that, strengthening in basis. But if I feel like, hey, this market's going to take off, and we need to listen to see what Dan has to say here in a few seconds, on whether, what the potential is really for a very strong rally. But you'd want to put on a storage hedge if you feel like, hey, there is going to be a chance for basis appreciation, and I want to lock that in. And we'll look at that. The other thing we can do is store unhedged. And that's just put it in the elevator, store it on farm, wherever. And I think that's what a lot of folks do. And that's also what is reflective in those two previous charts. That's unhedged. The other thing you can do is just sell that crop at harvest, right? That's what a lot of folks do. They just sell it. They're done with it. You can sell that crop and buy a call option. This would be a good tool to use if we feel like we're going to see a significant price rally, right? If we think prices are going to go up, hey, buy that call. Essentially, that's a minimum price contract, and it gets you take advantage of any price rises in the futures market. You can sell the crop, buy a call, and sell an out-of-the-money call. And if you call last several months on wheat, that's something we have implemented, and we're going to find out how that's turning out for us. And that's called a spread. But what that does is it allows you to make maybe the first part of a rally, but after the market goes so high, then it's a wash and you're really not getting any major run-ups. As always, your post-harvest marketing goal should be to better your position versus harvest values. And so we need to be cognizant. What's the price right now? A couple questions to ask. Who are we selling to? Right now, am I feeding my corn? All right, well, I'm the market. Do I already have some contracting with an ethanol plant, a feed yard? Do I have special arrangements with a oil seed crusher? Do I already have some programs going on that are going to implicate or impact what my decisions are? Will prices rally significantly? And again, we'll turn to Dan and try to get some insights on what our chances are of that. Is there carry in the futures market now? And we'll look at that more specifically, especially for corn. And then will we see basis appreciation? We'll also look at that a little closer. And then the last question is, what are my storage costs? Because I ran through some examples. I think they're pretty emblematic. They're good examples, but you need to get a handle on what your estimates of cost are. Okay, so first question, is there carry in the futures market? Looks like there is. And that's a pretty simple calculation, right? I went back last Friday, and December corn futures closed at 401 3/4. March, which is 3 months later, was 420. Well, the difference on that is 18.25 cents. That's the carry, but that's 3 months later. So you have to divide that by 3. And so the per month carry is 6 cents. And so then I carried that for each of the other 2 months. And, so from March to May, that's about 5.5. From May to July, it was about 3. So the carry starts weakening. The thing I want to point out is if we're looking at commercial storage, right, for corn, if we got a monthly storage cost of 6 cents plus 2% interest, if we're looking at maybe 6.5% interest, that's 8 cents. And so none of these are really, I guess currently the futures carry isn't fully reimbursing you for commercial storage. Maybe for on-farm, but not for commercial storage. Close, but not really there. I kind of went back and I looked at the last few months. July 1, and I'm just going to kind of quote the March carry. In July 1, it was 4.8 cents. August, it jumped up to 5. September 1st, it was 6, and now we're at 6.1. So the trend on that March carry versus December is actually growing, which is more conducive to saying, that market kind of telling us that maybe it wants us to hang on to this. May and July, a little bit more up and down, and they really haven't changed that much, kind of like I say, kind of up and down. But that March is slowly growing. And that's something as we get closer. Again, we're 26% harvested right now with the Kansas corn crop. When you're ready to start making these decisions, you need to recalculate that and see where things are at. Next question, will we see basis appreciation? And again, what I'm getting at here is that a lot of times we see cash prices get very weak at harvest, right? Because we got to figure out where we're going to store this crop. And so basis appreciation is that concept that cash prices are going to gain relative to futures. Convergence is the concept that cash bids and futures prices will converge, meaning basis is going to become nearly zero, or at least reflective of transportation quality, volatility, and delivery costs at whatever location we're talking about. And so, when we think about March corn, and that's kind of what I'm looking at here, is what kind of basis appreciation, what kind of convergence might we see across the state for corn? So in that lower section, I've got the March corn futures. As of last Friday, it was 420. And then I went out and I just looked at 6 locations across the state. Cash corn in Colby was 412. At the bottom of that, Chanute, Beechner was 366. So we see a fairly wide variation in prices across the state. And so what I did was I calculated the deferred basis. So that's not the current basis. That's not the spot basis. That's the March futures versus current cash. And again, so in Colby, $4.12 versus $4.20 is 8 cents. But you get down there in this eastern part of the state, Topeka, Chanute, we're looking at 58 and 54 cents. So that's a pretty wide basis, obviously. Then what I did was I went to our great ag manager site there. KSU manages that. And I just calculated for each of those locations the 3-year average. Now, I'm not saying it's going to be that, but typically when we try to estimate what maybe basis will be, a great place to start is taking a look at that historical average. And so I just got the 3-year averages posted for each of those locations. And so then, kind of can calculate then your expected basis appreciation, right? Currently, Colby is 8 cents under. We expect that, that third week of February, it may be 14 cents over. So that's an appreciation of 22 cents. Again, you look at some of those lower numbers there for Topeka, Chanute, we're looking at basis appreciation potentially of 64 and 73 cents. That next column is my commercial storage costs. Again, 6 cents a month storage plus my 2 cents, so about 8 cents over, getting it here through into that third week of February. And we're looking at 23 cents. So expected storage hedge returns from a -1 in Northwest Kansas. So again, the market's kind of telling us, no, we want your grain right now. In other parts of the states, that's not quite so clear. And especially as we move east, it looks at this point that, the market's kind of saying, there's returns to storage. Now, again, that is the expected storage hedge return. That's what you would make in basis appreciation, but you would need to sell that March futures contract. Now, and also keep in mind, we did this as of September 20th. If you recall, if you've watched these before, we started in April looking at the wheat thing, or this same approach for wheat. That's sorry for that description. Anyway, it looked like it was really going to work well in April and even in May, but by the time we got to wheat harvest, the market was basically telling us no, storage really wasn't going to pay that well. So those conditions could also change as we get closer and we get more into harvest. But it is something we need to continue to analyze for our own our locations. And this is a chart you often see, a table that I often share. This one is for Garden City. It's an on-farm comparison, 2024 post-harvest corn marketing alternatives. Again, A is just saying, let's just sell the crop, be done with it, move on to 2025. Okay, it was going for 422. That's my minimum price. Column B is selling the grain and buying a call option. And so March futures were 420. So I said, what would be an at the money call, a 420 call? That was 18 cents last Friday. So that's a negative 18 cents. My minimum price now was 403. For that position to break even with just selling and getting the 422, futures would have to rise to 439. Now, March futures were then 420. We're up, I think, a dime last time I looked. So we've already got a chunk of that. If we continue to see another 20, 30, 40 cents, that's looking pretty good. Column C is the sell the grain and put on that bull call spread, which is buying that at the money call, but then selling an out of the money call to lower my costs. That was only going for 5 cents. So it increased my minimum 5 cents to 407. It lowered my futures break even to 435. On the wheat side, when we were looking at that, it looked a whole lot better. For this, this run, it doesn't look that great. All the stuff then on the right side there in the white is sort of an on-farm looking at returns storage or the returns to a storage hedge. Again, current basis in Garden City is 2 cents over, right? 422 current cash versus March futures of 420. But typically in that third week of February, we expect basis to be 47 cents over. So again, we're going to see a fairly good a basis appreciation. Now, again, here's where I plugged in 6% interest, and that's 5.5 cents. And then we get the 1% shrink and a 5 cent in and out. That's another 9.2 cents. And so my expected price would be 455 and an expected profit of 29 cents by hanging on. Now, again, you got to sell futures to actually try to lock that kind of a thing in. So while it's early in the season, the market's suggesting there's a return to storage versus selling at harvest. And I'm going to kind of jump ahead here. Let's see here. This is the same thing for soybeans. It's Topeka. It's an on-farm comparison, post-harvest soybean marketing alternatives. And again, you kind of see the same thing. While it's early, the storage hedge really can look pretty good. It looks like an expected profit of 34 cents by hanging on to your beans until later. But again, we need to continue to analyze that as we get into harvest and are ready to make that decision. But again, $9.96 would be my expected price, well above all of those other three things: selling the grain at harvest, selling the grain and buying a call, or putting on a bull spread. So at this point, the market is suggesting for all of our fall crops to maybe think about hanging on to it if we can afford to do so. Okay, so spent quite a bit of time here. I apologize. I'll try to move on, get done here, give Dan a little bit of time. I want to do a quick review of a few previously shared marketing plans that I've been talking about pretty much all this year. That's the 2024 post-harvest wheat, the 2024 pre-harvest corn and soybean plans, and now also the 2025 pre-harvest wheat. So let's quickly run through those. Here's 2024 post-harvest wheat plan. As we talked about earlier, we 30% of our expected production we got forward contracted before harvest. We got 664 for that. We sold the other 70% because we felt like there was no return to storage. Sold that, but we did put the March call spread on. We bought a 620 call. We sold a 670 at a cost of 18 cents. Okay, so that's a cost. So where are we now? Again, I'll make money on that once we see March futures go above 620. If you see that graph, they haven't done it yet. So I'm not really making money on that position. Once we get past 670, then it's a wash, because the call I sold, the 670, will start losing me money while the 620 continues to make me money. And so after that, I'm not making any dollars. And at this point, I haven't either. I do want to point out, though, that March call spread, my maximum cost is going to be 18 cents. On-farm storage into late February, it's about 21 cents that you're going to have to pay. And if it was off-farm, say a commercial elevator, it'd be like closer to 41. So, relatively speaking, the March call spread was a nice way of re-owning it on paper, much cheaper. Again, check last Friday, that could have been exited at a plus 10 cents, which would have made my net option position, right? I spent 18 cents to put that on. I could get out for 10, so my net would have been 8-cent loss, making my net wheat price an average of 602 because I would lower that 610. I didn't pick it, but I didn't pull that up. I'm still waiting for that great rally. Pre-harvest corn marketing plan. Again, that's one we've been sharing all year long. For me, it's been a bit of a disaster. We got 10% priced at $4.91, and then we saw a $1.08 price decline, and we haven't actually done any pricing since because we've been chasing that $5 area, which we never hit. We are looking at potential rallies. Again, $1.08. 421 would be a 33% rally. Again, we're back up 10 cents or so today. So if we could get up to the 420 before I harvest and I'm ready to start selling, I might go ahead and do that, right? I might do that. I might go ahead and jump in and say, let's go ahead and price another 10% if I could get that done before harvest. But that'd be my target. Pre-harvest bean plan, same kind of thing. We got the first increment done. 20% of expected production was priced at an average of 11.82 CME November futures. Second increment, we were looking for 14.25. Obviously, this market is nowhere near that. We're now below my target. But again, I think I might consider it because we have been in a downtrend since 2022, and it's going to take quite a bit to knock us off that longer term trend as we go the next 12 months. And so I feel like we need to be a bit more aggressive on some of the things we do. So if we could see that rally up into that 1045, that 1040 area, I might go ahead and be tempted to price another 10% before I go into harvest, knowing that right now the market is suggesting that there is some potential for storage. Tentative pre-harvest 2025. Again, this is the week we haven't planted yet. Feel like we need to be a little more aggressive. This was put into the handout. I didn't talk about it last time, but I had targets of if we can get back up to 580, let's do 10%. And if we can get up to 620, which would be a 33% rally, let's do another 20%. We've hit both those. Okay, so that maybe kind of also adjust that plan and saying that, well, okay, let's not do another 20% until we see 660 July futures or by February 15th. So let's take a look at the chart. Again, on August 30th, we priced at 589 futures. We did 10%, and then we did 20% at 624. Again, that was our 33% rally. It was there for one day. We grabbed that. We're down, but we're back up. So now we're kind of saying, hey, if we can get up to that 50% rally, so up to that 660 range, that might be the time that we go ahead and do that third increment, another 20%. That would put us at 50% priced. But again, I look at this market and I say, we've been downtrending for 2 years. It's going to take a lot. Yes, I want to see a rally. We're seeing a bit of one. A lot of time yet. A lot of things can happen. But it may be better to be a little bit more aggressive because we didn't get much done this last year. And I think a lot of folks are kind of lamenting that. Okay, with that, I want to thank everyone so much. I'm going to turn this thing over to Dan, and obviously we'll be checking the comments for any questions that might be out there.
Mark, just to give you a little bit of ribbing, I think the key to the markets might be to have you talk. Once you started talking, we gained about 5 cents across the board. So correlation is not causality, but hey, if it works, it works. So anyway, Mark, thank you for that information. Great stuff. I look back on those marketing plans that we put out this year, and if there's anything that we probably you and I and Rich should think on, it would be what do we go with? Full economic cost of production as a goal? Do we go with covering direct cost as a goal? There was some pricing action we could have had, but we didn't, because we followed our, and I think it's a sound rule to not price anything below cost of production. And so the question would be, well, what were we including in cost of production? I think especially the land aspect of that. Some are, if we're paying a full cash rent versus ownership for land, that can vary by individual. Crop share could come into play too. Before I go on, Mark, any thoughts on that?
No, I would agree 100%. And but let's see here. You guys, what we use typically is sort of this weighted average price or weighted average cost from KSU Farm Management Guides.
That's right.
Typically, they'll be coming out for 2025 here in November. So I can't wait to see them. Right now, in my handout, we've got that I call it up. I'm dig it up here. My Kansas estimates, which is essentially a weighted average. It includes irrigated, non-irrigated, multiple rotations. But what we've done is tried to weight that by where we feel like the production is across the state to cut sort of what I would call create an average cost. And so we have that for 2024. And then really, we've seen some costs kind of weaken, fertilizer and some of these things. And I think a lot of folks are going to maybe spend less as we go forward. Now, I know, I use the term sticky inflation. I feel obviously commodity prices have fallen a lot faster than our input costs, but I also do have I think about slide 18 in my handout, estimates for 2025. And I'm doing kind of exactly what you're hitting on, Dan. We've got the direct costs, which are defined in the previous graph based off the Farm Management Guides. And then I kind of have a direct cost with cash rent to kind of give us that estimate of what my cost might be if I also had to throw in something for land. And then we've got the total economic costs down there too. And I've got that all for wheat, corn, and soybeans. So people can kind of take a look at that. And again, I think Dan will be the first one because you work on those budgets and you guys do a great job on them. But, that's just a budget. It's a benchmark. Everyone needs to, calculate their own.
Yeah. And the only other thing I'd say on that is that, once you get past direct costs, at least how we categorize them, it's either land or machinery. And what do you have to cover, to live to fight another day? So anyway, let's go on. It's I don't want to be over dramatic, but in all these times in these markets, it's always there's always some set of factors that are still coming at us that add uncertainty into the markets. And so far, I think it's fair to say the predominant issue through this summer has been generally good crop production conditions in the U.S. And you look at the most recent September crop production report, you've got great corn yields in the 3I states at all over 200 bushels per acre. And actually, maybe if you add Idaho is the only other state above 200, maybe we need to call it the 4I states. But anyway, Idaho has great corn yields this year too, not many acres though. So we've got that going on, and yet we have these factors out in front of us. There are go back to what Seth Meyer, when he spoke at our Risk and Profit conference here in August, he talked about the wheat market and how it was confusing to him with a hot war going on, that we weren't seeing more movement in the market. Well, I think the market is sort of how can I best say this? They have kind of a well, it'll take care of itself. We'll deal with it type of a mode with regard to Ukraine, Russia. We're not that initial run up that we'd see in the markets. You can see it on this chart for corn. A lot of what happened here, 2002, 2003, was the world really concerned about Ukraine's ability to still export corn and wheat in particular. So we saw that a lot of this run up was just fear in the markets, and that fear has gone away because the market's seen the response of Turkey, the UN, and others to get in and mitigate that whole deal. Well, now they're just for something to think on. There's a hot shooting war going on right now in the Middle East, I think with Hamas and Israel. So I'm not trying to bang the drum one way or the other, but you read market commentary, and there's some concern about that. So those things have far-reaching issues on transportation, on financial markets, and eventually come into the confidence that the market has, and comes into play for affecting commodity prices. So just want to say that we're going to talk about U.S. supply demand and foreign supply demand information in the most strict quantified sense here in what I'm talking about. But there are some of these other factors out there that are roiling up the markets, much less a U.S. election, that can add uncertainty and volatility in ways that our strict grain supply demand balance sheets don't always handle very well. So just be thoughtful of that. So I want to go quickly here. Corn, you can see we've come off of the August numbers, which were the lowest we've been since back in the highs of 2022, have come up. We were below $4 for the lead futures contract at, I think, 370 or something like that, 390, somewhere in that range, and are now up to 407.5. And again, today, just one day, but we are up double digits at least right now before things close. And just a question where this will go. You have seen some of the. I put this up as a chart to show where traders are at. This was the latest data that came out on Friday. And so you can see that, yes, the market did hit not a historic market low with regard to short positions for managed money traders or speculators at 2.5 billion bushels, 2.55 basically, but has receded from that a little bit, but still not a major change. So if something's coming, it hasn't shown up yet with a lot of people that trade to take advantage of positional moves in the market, the price moves in the market. That they have not revealed their hand that they are bailing out of anything yet, other than, hey, it's softening just some. Pardon me. For soybeans, we did see the low of 932 during the month of August for the lead contract, up about 90 cents to 10.25 on that'd be Friday's close, and it'll be higher yet. It'll make it $1 higher off of that. So something to think about. I wanted to show on this end of the corn market when the lows hit during those years, and sometimes it's early, sometimes it's late. But as it is, we have come through August, and the markets with this narrative of large supplies. Get out of my way! Yeah, large supplies that we went down to these levels, and now we're starting to come back off of that and I'll talk about some of the questions about the final USDA numbers that are still out there for U.S. crop size in just a second here. And soybean numbers, that, again, other than the scale differing, you do see that a record bearishness that happened, 957 low in the futures that happened basically within the last month, have come up now to about 1006. These are Tuesday closes on the market. So again, the market has not turned the corner away yet. Now for soybeans, you have dryness in parts of South America, Brazil in particular, that's starting to cause concerns about getting that crop planted. Still quite early. There's one soybean crop that goes in and been planted September to starts in September, finishes on in November, December. Depends on what, how far north and south they are. But we at least with where we stand right now, the most bearishness that was in that market was last month, and we're starting to see some positive price direction. And yeah, you can see and this is for hard red winter wheat, had a low in August of 527 and a quarter for the lead futures contract. Now we've gained, arguably about 50 cents from that, and up another. If the gains so far today hold, you'd be up 50 plus cents or so from where you were, where we were back in then. And you can see all over back to 2014 where the low months were. And I think it's fair to ask. So for wheat, we right now there's not anything in the cards that the market is paying any attention to that would merit the type of rallies we had in 2022, 2023. But as you'll see later, we continue to tighten in that market. There's still at risk dryness coming into some key areas. So I think it's fair to say that yes, we still have pretty much an oversupply situation, and Russia more than willing to dump wheat on the market, on the world market, keep prices low. However, I guess we're not in a situation, a scenario where there aren't risks, and it sure bears watching. And another shooting war over in that part of the world just adds to that riskiness. You can see also here for hard red winter wheat that the main lows had hit earlier this year in terms of most recently 465 million bushels of short positions. That the blue numbers are long positions, the red numbers are short positions. I'm not netting them out. There's another slide that you've got in your deck that we sent out that nets these out, but you can see the predominant bearish position in the wheat market right now, and it quote is as it is. Take a look at weather. Showing these next slides, a 90, 30, 14, and 7-day moisture situations here in the U.S., so you can kind of get a picture of what's been happening of late. And really, for us, it's dry conditions help on harvest, but we also are looking to seed wheat in Kansas and in the central southern plains. So 90 days ago, you can see the areas of the U.S. that were drier, and actually Indiana and I think West Virginia also having dry conditions, parts of Nebraska, parts of Kansas, Texas Panhandle. You get 30 days ago, and that all turned pretty hot and dry. And those last 30 days were pretty important time frames for they affected corn as it finished out, but probably if it affected any crop, it's probably soybeans. So I think that just gives us something that will bear watching as we look at the upcoming October crop production and WASDE reports. So we're sitting here on the 23rd, a week from today, be the 30th, and the USDA crop enumerators, the observers, will be in the field at that time, days in front of and behind October 1. And then what they get there, that'll go, but what they find from their observations will go into the October 11th report. So, quote, bears watching. And then you got last 14 days, no necessary change, and then the last 7 days. Now, as we talk about this, you read the weather forecast this morning. There's some forecasts of moisture coming into the Corn Belt. That Central Corn Belt, we had a little bit here in Kansas, not as much as had been thought would come, but these are issues all in play. Note that moisture that there in Kansas, that's a positive for hard red winter wheat seeding, although I guess for hard-bitten old Kansas wheat farmers, they'd rather have a full soil profile. That's just the reality of it. But we live to fight another day and get the wheat in, and wonder where things are going. Drought monitor showing really pretty widespread drought. All of Kansas included, most of the Corn Belt, and particularly that eastern part, Ohio, coming into play. We have some dryland corn issues, non-irrigated corn issues in western Kansas. No doubt some impact in varying degrees across the state. Up into Nebraska, they've had some dryness. I hear of very dry conditions over in, again, you see Ohio there, the very eastern corn belt, too wet conditions in Iowa, southern Minnesota. So, but yet, when you look at that last report, all the corn yields in these three states, all over 200 bushel an acre projections, soybean yields all over 60. But there's no other places other than that Idaho situation for corn that's really coming as close to that. Forecast to the end of October, so now we're getting into the breadbasket of information that wheat producers would be looking at. So it shows as they look at seeding here, some started now, they'll be going on into October. Pretty dry in our part of the country, really pretty dry through hard red winter wheat country overall. And you look at through December, really no major change other than the drier areas moving a bit to the east of us. And when we look at the issues that the market's concerned about, you look at the ongoing dry conditions. Some have indicated, some of their climatologists in that country have indicated these are historic hot and dry conditions that they're planting soybeans into. And of course, if you start waving your saber around saying, oh my gosh, it's a major problem, well, it could develop into that. There's a lot of time yet. So I think the market looks at this as something to watch. And so Mark, you talk about storing these crops, soybeans in particular, corn and soybeans. The weather happenings down in Brazil in particular, Argentina also will have a lot to do with the skittishness of the market. If that was straight wet and no problems with South American prospects, I think we'd be looking at a far different situation. And in terms of the likelihood of the profitability of storage, here you've got you can see up in the Black Sea region, Russia in particular, some of the dryness that the market's talking about. On the one hand, you hear they have not ideal conditions. There are issues at play there. Then on the other, you'll read they're still aggressive selling wheat. So hard to read what they're doing. But you've got this map that shows the wet weather map that shows the dryness up there. I'm not going to show the next one, which is from NASA. It's a satellite map that puts all of Europe and that area in particular in the worst of conditions. But that's probably a little over dramatic, that next map, but it's dry over there. And again, we talk about the one issue that the wheat market hasn't had is that when buyers have wanted to go buy wheat, they couldn't get hold of it, or they didn't have to bid a lot more than they were expecting. But you get droughts in both dry conditions in Ukraine and Russia, problems that have occurred in parts of Europe and elsewhere. I was creeping concerns on what's happening in Australia, and those are the things to watch for wheat. If people haven't sold their wheat, are they still looking for some run up that could happen from this or these geopolitical issues we're talking about? No doubt those factors could come into play, but I guess that's just part of the normal set of both production and geopolitical economic factors that come into play and affect these markets. Right now, the big factors here of late have been, COVID came in and affected things. Ukraine-Russia war really affected things, and a few droughts thrown in. So I think conflict in the Middle East roiling up financial markets. We're not quite sure where things would go. A lot depends which countries are involved.
Hey, Dan.
So, yeah.
You mentioned about just specifically there on the wheat, if you had it in the bin, maybe we will have a chance. Maybe it'll go up enough to cover, maybe not. But if we're looking at, let's go at the next year's crop, the one we don't have planted, the one that's going to be put into some very dry stuff. Earlier I kind of had a thing of saying, hey, maybe my next target would be 660. Currently, I'm talking again, so prices are still good. It's like 604. Should people kind of be maybe 660? Wait for July futures to get even higher than that, or is that a good target? Which is, it's 55 cents higher than where it is now.
Well, it's a possibility, right? The forward contract numbers, right now, or on Friday, they're higher than that now, of course. But in Salina, the 550 forward contract, 40 under July wheat at 590, July 25 wheat at 590, and the highest forward contract bid actually was in Hutchinson at 555 and 35 under. So what you're talking about there is basically we'd be anticipating a move in the wheat market. I was going to say seasonal, but I'm not sure that wheat has that much seasonality, to it. So you ask. So here, Mark, you've asked me a straightforward question. I've talked for 3 minutes and haven't given you a straight answer. I'm not sure. All I know is that the market right now isn't given that. If you do that, you'd have to be waiting in somewhat of a speculative manner for the market to respond to the high side. I think a lot of farmers are comfortable with that if they have the cash and they're not paying margin calls. But if they get involved in the futures or buy a call option, then suddenly it's cash and they're paying interest on it and all that. Does that help you any in answering that question?
I think a little bit, yeah. Like I say, my question a little bit is, given all this dryness, should producers, I don't want to say put the brakes on any 2025 further forward pricing, but if we would see, a rally up to, is 660 enough? I mean, or is that, 660 futures? Because like I say, I think you mentioned it was a 540 forward contract bid.
Yeah. Forward contract bids across the state range from 505 lowest. This is for wheat. For Colby, the highest was at 555 in Hutchinson, and everything. Salina, Topeka, around 550, 547, 550. That was yesterday, and they're a little higher now. So
okay. And so what I was wondering is, if we do see another, say, 50 cents put on that market, would that be a time, because these forward contracts would go up too, would that be a time for people to say, hey, maybe I should do a percentage? Or is it, no, why don't you wait for futures to get up to 7 before you go back?
Well, Mark, I think the thinking that you've introduced, that we've tried to bring through these winning the game marketing strategies, is that rather than to think, do I do it all at that time, do I do a proportion of it and start to take advantage of that, with the idea that, hey, if it got there, it might keep going. So is that 5, 10, 15, 20, 25% of what you anticipate you'll produce next year? That would be a thought I'd have. Why don't I, in the interest of time here, I'm going to hit on the very highest of points on the feed grain markets. So we'll be going past some slides pretty quick, and so just hang on. Here we go. Did want to show the carry in the market. Mark, you discussed this. So right now, just in the futures, without any basis narrowing, no basis strengthening or appreciation, you've got, you see this bottom line down here from this is corn futures, the September lows. Coming out of the September lows, you've got about 4 cents a bushel a month through the December contract, about 6 cents from per month, 18 cents, a little over 18 cents total going out to the March futures, another 5.5, basically 11 cents going from 420 to 431, and then another 3 cents there. And this time frame, March, April, May into July, is the sweet spot for where people that do store corn tend to go. So that's something to keep in mind. And the seasonal price patterns that we've got I keep in mind what we tend to have happen. We come right here through September and October. We've got a fair amount of variability. We tend to get into a chokehold, and once we get December, January, February, March, until we get spring action going on. So it's thought provoking, Mark, as you say. So to store would make sense, but if we do have these large crops, and I think we're going to have large crops. We're just quibbling about how large they're going to be. That you're probably, absent weather issues in South America or geopolitical whatever, we'd expect on average to get pretty tight and wondering what in the world if there's light at the end of the tunnel in January, February, March. But then in the spring, start to see movement. Your storage you're talking about, we're storing April, May when we get into this volatility. In through here, absent South America's having problems or other issues, we just tend to clutch. We get, it's a tough time to market grain. So keep that in mind. I'm going to move just because we are tight for time here. I do want to show you. So this is what USDA numbers were in September. September 12th report. 2.05 billion bushels ending stocks, 13.7% stocks to use, and growing stocks to use. So now that they've got a price with that, basically 410, and there's that same percent stocks to use figure. In my own thinking, there's so much momentum, so much, I guess. Consensus about, hey, we're going to have large crops, that it's at least a coin flip situation. And we'll probably get it. At 183.6 bushel per acre, corn yields, crop size 15.1, basically 15.2 billion bushels. There's the ending stocks. There's that price. But hot weather that's come in, still questions about how all this could work out. If there are ramifications if we just get a tremendous yield, which would be like 182.1. Again, the record's 177. Say a 25% chance of that, and basically a 40% chance of something lower. And Mark and Rich, you can say, well, you're just a bitter clinger to the hope that's not a hope, to the possibility of yields being lower. And so if our NASS friends are on here, I'm not cheerleading one way or the other. I just think, gosh, when I look at, if you go to the back of this NASS report and look at the risks of different outcomes, you still got there's a 67. If you look at the range that they say they have in their yield estimates, there's still a range of, from 14.7 on the low side to 15.67 on the high side in terms of what they say historically their estimates are. And if we're tending to miss on the high side on this, then this 182 bushels an acre is well within that estimate range. So they're looking at a plus or minus 2/3 estimate of being and this one even hit the low end side at 14.8 billion bushel. And if you do get these situations, and have about the same usage, it's still record high crops. Usage probably won't adjust that much. You're scaling back 123, 250, 378, almost 372, almost 400, and to lose 150, 120 million bushels ending stocks, tighten things up, has ramifications, about 40 cents worth. And you just keep moving towards, if you go lower than that, then that affects the market supply demand. So I just wanted to point that out. My point is not that I'm trying to outguess the market, but there's still risk out there that has to be dealt with, and the USDA stats on how accurate they say they are is it basically supports that. Let's go on. I want to show you some for world stocks. We're still pretty tight on world stocks to use for corn. World minus China stocks still downtrend. So we're not just sitting with abundant stocks. It's kind of a conundrum. Tightening stocks in most of these commodities, and the prices are as low as possible. I think it's because we have commodity in hand. If that ever gets shaken, then we'd have a different price outcome. Let's go take a look at. Just would want to say for grain sorghum. You can see the dependence of grain sorghum on exports, and 95% of those exports go to China. So as long as the Chinese don't interrupt their purchasing of exports from the U.S. for grain sorghum, then this will continue to be supportive of the grain sorghum market. Wheat market, we want to show you market with what you said. There is some carry in going forward. Now we've absorbed a whole lot of losses on the way here to get down low enough with the current contracts to have carry going into the future. But beyond from basically the September contract, as it closed out to where Deese is at now, we're still went from 579 to 564, so still losing about 4 or 5 cents a bushel a month if we still have the wheat. If we're still holding it, then yeah, 4.5 cents a bushel per month out into May. And by the time we get to May, our attention will be turned to next year. And September, October, November, December, if there's a constrained chokehold where we don't have a lot of change going on in that market, we're sitting on the precipice of going right into it. So that's something to think on for wheat. Would say that for wheat, in my view, it's a matter of where the exports go. We have the supply for the U.S. pretty well in hand. Do we have a situation that bumps us up, that takes us lower, or bumps us higher by 50 million bushels? I just use that number as a reasonable amount of change. And if we go lower than 570, then we decline. That's the USDA projection right now, 525 lower. That's how the stocks to use and price relationships work out. If we get stronger wheat exports, and that right now would be a surprise to the market. It would bring about emotion. It would bring about fear that the world could not get that elsewhere. And then you see a number out there that's over $1 higher than where we're at. And until that comes, I don't. When I think you were mentioning, Mark, that it doesn't look like, or maybe I'm putting words in your mouth, doesn't look like a lot that'll change the wheat market. Well, if we get only 50 million bushels more of movement in the U.S., it changes from 570 up to about just under $7. But you're waiting on things to happen. That right now the market overall is not in their narrative thinking is going to occur. And let's go to soybeans. And you can see for soybean futures, I think these are amazing carries. And with what you're talking about, Mark, we closed out September, the last price it traded on was right at, or basically 987. Now, this is low today, 1012. So we've gained about 13 cents a month, 26 cents total. What's it? Yeah, they're about 20 to 29, 27, I guess. And from then to 1030 to 1044, 1058, 1068. So you're covering more than commercial storage in most cases, unless we're at 7 cents a bushel now per month. all the way out to June and such. And these, if we were an elevator, we'd say this is a hedging opportunity we cannot pass up. If you were operating in that mode and we're trying to not expose yourself to the futures, but in a farm situation, we've got per month returns to storage that cover that. Well, I guess I'm stumbling around to say they look pretty good, and so it's worth considering. But we're not in the mode of hedging of hedging on our own that far out. That's just the issue of it. And where's that chokehold come in for soybeans? Again, we've got volatility now, but at least by our Kansas seasonal average price movements, we tend to constrict January, February, and then when we get out into April, May, June, then have more volatility, more movement coming in. The futures are pretty flat, but the historic volatility shows that, hey, that's when risks come. So, Mark, let me finish one more thing up. Then after season average price comment or charts, I want to ask you if how that does that affect your thoughts on the storage things we talked about earlier. New crop bids. Note, I wanted to show you this, that there's a new soybean crush plant coming in southeast Kansas, I think Cherryville, and just noteworthy to me that the top bids for soybeans in Columbus area with 982 is at least 20 cents a bushel more than anything else. New crop bids for new crop, that'd be 25 bids, 1010, and the next highest ones, well, it's higher than Topeka at 998, and some others aren't too bad. So thought-provoking just to see what the impact of a new processing facility down in that area might do to that market. And come in here, let's see, to finish up then, soybeans, USDA numbers, 53 bushels an acre. With the dryness we've had, I think there's a little more risk that number may come down. 52, 50.8, still great, very good soybean yields, but not quite the bloom that the September 1 numbers were. And what impacts do you have? Well, if this scenario doesn't work itself out, again, 90 cents by the time you crunch the numbers, differential in prices, and goes even higher. By the time you just do the math and just put down what it says, you're kind of afraid to say it, because it's a dramatic change over almost, well, $2.50 or so per bushel if you really fall short. But that's just the reality. So I know here we are past one. Mark, I want to come back and see if you have any comments on that. And Rich, we can open the comments and questions up if you'd like also.
The only thing I'd add would be, I apologize for taking so long, cutting your time a little bit. But no, I think I agree. I think both, we were looking at things, well, we look at things the same because we're looking at carry, we're looking at potential basis appreciation. But I think we both would agree that okay, it looks like there could be some returns to storage now, but let's all wait till we get the beans and the corn cut, right? We haven't really started soybean harvest yet, so let's see what basis does over the next 30 days or so, because all of these things are going to change a bit. And but right now, let's start running the numbers, and it looks like there's some opportunities for storage.
Take note for wheat that here a week from today, the USDA will USDA NASS, and I don't know if Doug's on here today from NASS, but anyway, they'll be releasing their small grains annual summary report. And there were no changes in anything in the September 11th report, but the October 11th report will reflect anything that those wheat numbers found. And anymore, there's likely to be a fair amount of change that happens. Also, take note that's the same date that the grain stocks report will come out, and the USDA has a recent history about the last 2 or 3 years of coming in, and by the time they get that September stocks report, they back calculate their balance sheets and they figure, oh my gosh, we were either high or low on the crop last year. And that's by 50, 80 million bushels or something. And that's not a problem. It's a tough job to calculate this stuff. But that's a week from today is the potential for a lot of volatility in the market, or a fair amount of volatility that people need to be aware of and not sleep on if things start to move. Give some thought to this. I think this is our last planned ones of these this year, unless the markets start to move and the scenario changes. So I guess I would say our plans are to start this back up in January, unless as we get in over the next 3 months that the scenario changes so much that we need to come back and talk to folks. So Rich, Mark, is that kind of your thoughts as well? Are those your thoughts?
Yep.
Yeah, I follow you guys' lead, and I'm always just happy to have the opportunity to be here.
Okay. Well, thank you, folks. Thanks for showing up today, and we'll at least at a minimum start this up in January, unless conditions warrant, and then we'll offer it sooner. So we'll see.
All right. Thanks, Dan. Thanks, Mark.
Thanks, everybody.
Thanks. Take care.